Um, well, my side still says waiting for STR University, but you're saying we're live on YouTube?
Yes, right. We are live.
Okay, cool. Well, thank you everybody for taking time on this Sunday. I'm sure everybody has a lot of things organized, planned, family, friends, and dinners and things like that. But I do think it's really important to get together. It says 13 people waiting, Hardik. Oh, there we go. University, but oh, you're saying we're live on YouTube?
Yes, right.
Okay.
We are live.
Okay, cool. All right, now I just muted that, so I think we should be good. Okay, in any event, I think it's important that we get together and address questions that we all have. And so I want to make sure that we save time for you each to ask questions. We're going to do it the way that we've done it in the past, where Erica reads to me the questions so that I can just continue to speak. But I think my basic thoughts are as follows. This is obviously unprecedented times and very challenging times. A lot of the things that I thought would happen have already, in fact, occurred, namely in the stock market. And the reason that I focus on the stock market is not only because it's an opportunity for us entrepreneurs to express views and monetize opportunities and also exit stocks in a timely fashion. But one of the main reasons I take a look at it is because the stock market is a forward-looking indicator. And a lot of the things that we look at are either lagging, they're in the rearview mirror, or they're real time, but it doesn't tell you much about the the forward economy. And by its very nature, that's what the stock market does. It's a forward look. It discounts what we think is going to happen in the future to today. And while it can be incorrect, it can stretch, it can be overvalued, it can be undervalued, at least it's something that's looking into the future and gives us something to talk about. So in that regard, what we've seen is a tremendous V-shaped recovery in the stock market. I don't believe that we're going to see that in the economy, but I do think that the stock market is telling us that the biggest companies, especially in technology, are going to be okay. Hold on one second here. Oh, Hardik. Okay. And so what we're seeing right now is a very significant rebound in the stock market. Perhaps we've gotten ahead of ourselves. I've shared with you stocks that I personally own and like, and I would say that I like them less at these levels. So if you've missed the buying opportunity, I wouldn't chase the returns. In fact, I would probably sit on my hands at this point. And I think that there's a good chance that you'll have a better opportunity to enter the stock market at lower levels in the future. So there's a lot of liquidity on the sidelines. There's a lot of people who have learned to buy the dips, who have listened to some people suggesting to buy the dips. But I just want to caution everybody that we're only down about 16 or 17% in the global stock market. And the world is, far from 15 or 16% versus where we were just 45 days ago. So as it relates to the stock market, if you haven't entered, I would pause and wait. I think you'll have another opportunity to buy lower. And I think that the real question is, where are we? And the more that I think about it, and I've spent the last couple of weeks, I've been kind of silent on YouTube, not filming videos, and not because I didn't want to film videos, but for two reasons. One, I'm going through the same sort of exercise that you all are, trying to rationalize, recognize, understand what's happening, making sure that my businesses, my short-term rentals, my loved ones are safe, sound, and so on. So I have the same challenges that you all do. And secondly, I think it's a really important time to be contemplative and pensive, and it's less about volume and speed, and it's more about thoughtfulness and caution and thinking about the opportunity set. So in that regard, I've been by design thinking and not just posting on YouTube. I filmed a couple of videos earlier today with Erica's help, and I think that they're quite thoughtful and will be helpful. So come back to YouTube and check those out over the next, week or two, whenever Charles releases them. But in the meantime, I've spent a lot of time thinking about sort of pandemics of the past and what's happened to travel and what's happened to spend and analyzing the actual data. Now, we haven't seen anything on the same level as COVID. So the results from SARS and some of these other pandemics that we've seen and analyzed are a much smaller subset. So they're not exactly practical or accurate, but it would be foolish or foolhardy to just dismiss them or not even look. And we'll get to some of those trends and what I've seen there as well. But where I want to start is the reopening process, because the reopening process is critical to our economy, which is critical to the stock market and also our short-term rentals and housing prices and so on. And by way of example, consumer spend is a huge portion of GDP, gross domestic product. Here in America, we're one of the most consumer-oriented spending machines on the planet. And I think as much as 70 cents on the gross domestic product comes from consumer spend. So those are individuals that might be living paycheck to paycheck, but every single paycheck they're going out and buying whatever, clothing or purchasing services, whether it's nail salon or going to the movies or restaurants. So our economy, especially here in the United States, is very much dependent on consumers and their health and well-being and them continuing to spend. And in the shutdown, spend has been virtually shut off, although we're spending differently. We're seeing patterns emerge that we have yet to see. All of us are aware of Black Friday, which is traditionally the biggest shopping day of the year, and then Cyber Monday. And what we're starting to see reports from companies like Target is that on their online platform during this COVID crisis, every single day is equivalent to Black Friday. So the consumer hasn't stopped spending, although I have, and I encourage you to. Like, I don't need to buy something today. I just don't. There's so much uncertainty in the world that the dollar is better in my pocket than in someone else's. And until I know that I can recycle or build or grow another dollar, I'm just going to hold on to my existing dollars. But the American consumer is alive and well. Well, for the most part, there's 20 plus million that are unemployed, and I assume that they're not spending. And I think that that number continues to grow. But we need to get the consumer spending. Another platform, Shopify, which many of you know, is sort of a do-it-yourself website. So for people that are in e-commerce, many of them are on Amazon's platform and fulfilled by Amazon. They sell through Amazon, but also many are creating their own websites and taking charge of their own business, very similar to what we're doing for short-term rental hosts using HostSaver. And Shopify is saying that on a daily basis, they have the equivalent of Black Friday every single day too. Now, some of these consumer behaviors are modifications of existing behavior, but they're here to stay. So it's my belief that people will continue to do more and more online, and that retail is going to have a challenge going forward. Although people do enjoy going into the store and that whole shopping experience. And so like elements of that will survive. But I think a lot of the things that consumers have learned to do will be here for the future. So what have consumers learned to do? Consumers have learned to purchase online. Maybe it's staples, food, clothing, things that they didn't do before COVID. Now they're doing by necessity from their home. Consumers have also learned that their job does not require a physical location or a common space. So corporations are learning we're just as efficient, if you will, from people working at home as if they were to come into the office. And so that changes corporate spend, because who's going to spend as much money on big, massive, impressive headquarters and so on. And so I think that there's a lot of things that COVID has really accelerated. And that's all it is, right? Like, these trends were emerging and they were coming. And what COVID has really done is accelerated it. It's forced us all to address certain needs and also, push aside things that aren't very necessary. But in the aggregate, it's important that the economy, as best as possible, as safely as possible, with social distancing and with keeping, say, those with immunodeficiencies and or the elderly or people that are sick, they should be quarantined, and the people that are healthy and able-bodied should resume working as quickly as possible, again with social distancing and with masks and with far better hygiene. And there's things that will come out of this that are for the greater good and will become currently like part of our everyday life. So I said on the last live event, if you've traveled before 9/11, it was a much easier process, and you didn't have to take your shoes off, and you didn't have to, take your belt off, and you didn't have to wait in as long lines. And post 9/11, once we saw how terrorists act and behave, we put in place measures such that that is much harder to do, and hopefully never happens again. Well, post COVID, we're going to see similar restrictions for the rest of our lives. We may see masks on airplanes, for instance. I don't know exactly what the rollout looks like, but in that reopening, it's really important that we experiment and we learn and we see what's working and what's not working. And I think that there's a lot of really good things that are starting to happen. I follow obviously the locations where I have short-term rentals very closely, and we're starting to see guidance from, say, Dare County in North Carolina, where the OBX project is. We're starting to see guidelines from Gunnison County, where there's another home that I manage in Crested Butte, Colorado, how they're opening. And in each case, they're reopening slowly and gradually, methodically. They're inviting non-resident homeowners onto the islands or into the county first in a systematic, controlled approach. And right now, in each of those locations that I just mentioned, they have yet to announce when tourism will resume. They're kind of waiting to see what happens when non-resident homeowners come in and do the cases spike, because that's the worst case scenario, is that we open up too quickly and then we have to quarantine a second time or shut down, which is actually what's happening in Singapore. That is not only terrible for the economy, it's really terrible for the mindset and the psyche of the consumer, because we are already living in fear. And if we were to shut down a second time because cases were elevated or spiking and there's more deaths and so on, we will live in even greater fear. And the single biggest importance in our economy normalizing and consumer spending comes down to confidence. A consumer that is not confident about their job, about the economy, about where their next dollar is going to come from, is going to do what I said earlier and just like shut down, sit on their hands and not spend. And as I said earlier, about 70% of GDP in America is based on consumer spend. So if we want to get the world spinning again and into a more normal pattern, it's really important that we create confidence so that consumers can go and have jobs and earn wages and also spend. Now, that's easier said than done, because if you think about social distancing, a lot of the things that we've taken for granted are suddenly now in question. So let's talk about restaurants, which is one of the reasons that we all live in the communities that we do live in. Part of the quality of life is restaurants and culture and services and whatever, movies, theater. But some of the proposals that I've seen on the reopening suggest that restaurants that are currently limited by like fire safety standards, so you have a square box and it's a restaurant and you're allowed to have, let's say, 100 people in there based on fire safety, they may be reassessed and no longer allow 100 people in there for fire safety, but only allow, say, 50 people for COVID and pandemic and virus safety. If any of you are in the restaurant business, and fortunately I am not, although I have a lot of friends who are in the restaurant business, it's a really competitive, tough business in the first place. It's really challenging to be successful at it. It's really challenging to have it be successful over an extended period of time. And most of those restaurants have those challenges when they have that 100 seating capability, and their challenge is just to get 100 people in there. And in many cases they do, and they eke out a small profit, but it's more of a labor of love than it is, say, a profitable venture. Those same restaurateurs now are going to be that much more challenged if they're told that they can't have 100 seats, they're now going to have 50. And while that feels great from where we are, we're at 0 right now, or maybe they can just do, curbside delivery, or they've partnered with Caviar or Grubhub and they Uber and they do delivery. That's like 8%. My understanding is that restaurants that are delivering are doing about 8% of their revenue. So from 0 or 8% to go to 50% occupancy, is going to seem like a big deal. But if we take one step back for a moment and pause and think about it, if these same restaurants were having a lot of difficulty operating over the long term profitably with 100 seats, virtually none of them will survive, in my opinion, unfortunately, with 50. So there's got to be a lot of different things that go through. We have to get from 0 to 50 quickly, and we have to get from 50 to 100 quickly. And if we never get to 100 quickly, then landowners or the people that own the space that the restaurants lease may have to reduce their rent, and taxes may have to come down. I mean, there's a lot of different levers that may have to come down so that the concept of having a restaurant for profit is successful. And I don't really mean to dwell on restaurants per se. This happens in every single industry, which is why this global pandemic is just so incredibly challenging for the global economy. Many of you know I also own a transportation company, or a limo company, if you want to think of it that way. And I took great pride and satisfaction in running this business for the last 12 years profitably. And one of the reasons that we did so profitably was that I intentionally, by design, targeted the business traveler. So people that were less sensitive, say, to pricing and were more interested in service and reliability and safety, and we could price accordingly. Well, in that area, business travel is an area where I think is going to be really impacted. So it's just every single industry that you look at, by and large, has been affected, and in, I would say, 95% of them negatively. So the challenges from reopening to getting people confident, to getting people to spend, to getting small business owners who are taking risk to continue to take risk and continue to operate is great. And unfortunately, there will be a significant number, and I don't know what the percentage is. In history, we'll figure it out. But there will be a significant percentage of businesses that just never reopen. The entrepreneur says, I wasn't making money before, I'm not going to make after, or I was barely making a little bit of money, now I'm going to go get a job. Or in some cases, people that were losing money just say, if I wasn't making money before, I'm definitely not going to make money after. And so they just don't open. And in places like New York City, that was already going through its own real estate sort of correction, prices were down 20 or 30%. And I followed that really actively. I just sold a very significant asset in New York City, thankfully on March 2nd, which is the date that we closed. So I missed a lot of this panic and so on from the pandemic, sitting in cash at a 1031 exchange in escrow, and I have to repurchase, but I'm following that market really carefully. I would say 25% of the retail establishments in New York City before COVID were already vacant or boarded up or for rent. And post-COVID, a lot of these restaurants, services, dry cleaners, et cetera, may never reopen. So a place like New York City that was already going through a challenging time is going to have an even more challenging time, making it even less desirable. Not to mention, I have a very negative bias and outlook on places that are dense and urban and filled with a lot of people, right? Like, one of the things that we're learning through this COVID is social distancing and space. And, New York City and other very crowded metropolitan areas are the exact opposite of what this COVID pandemic has taught us. So we need to start to think about the broader, more macro economy, and then ultimately get down to what does that mean for us. And so to that end, I want to share with you a couple of thoughts in the short-term rental market based on macroeconomic theory. And by the way, this is just my opinion. I happen to think it's well thought out, but nothing would please me more than just being wrong, right? Like, I would love for the world to resume more quickly and spend to come back more quickly and consumer confidence to come back more quickly. The Federal Reserve and central banks all over the world are doing everything in their power to print a lot of money, which has its own set of consequences in the future, more likely problematic for my children and their generation than mine. But in the tail end of my life, we'll start to see a lot of these concerns come to roost as well. And the primary thing about that Federal Reserve stimulus and so on is, while it's massive numbers, it's about 25% of GDP, and I don't know what the latest number is, maybe it's 10 trillion or so in the United States. Recognize this: it's actually not stimulus yet. meaning while it's working its way through the system today, it's really only replacing lost wages, lost spending, and so on. It's not actually providing the stimulus it's supposed to. It's just replacing what was lost. So we're kind of like somewhere around break even, if you think of it that way. And when I think of the stock market in those terms, everyone's staying at home, businesses are shuttered, we don't know when they're going to reopen, restaurants may not be able to reopen at full speed and pace, and so on. I just don't see how this is a positive for the consumer or the economy, or for spending. I think it's going to be more challenging. And again, I hope I'm wrong, right? Like, I'm not trying to sit here and be gloom and doom and depressed. In fact, I'm very optimistic once we come out the other side. We always learn from these things such that we don't repeat the same mistakes again, and we're better prepared. But it does have some implications, right? So like each country has shut off its borders. We're now in a protectionist environment as opposed to a global environment. We are going to start to manufacture in the United States and in individual countries and stockpile and be prepared with PPE, protective equipment for medical professionals. We're not going to be reliant on it coming from, say, China, and ventilators and all that stuff. And so the next time we see something like this, and rest assured there will be another virus, this isn't the last virus, we will be better prepared, and people will shut down quicker and will self-quarantine. And so even though it's a very frightening thing, it's something that we've now experienced and learned from, grown from, and on many levels will be better prepared on the go forward basis. So how does this relate to your short-term rentals? And then I want to start taking some questions. I think that the biggest risk that I see in the short-term rental space is if you are providing generic, nondescript units of rent in dense urban areas. So I don't mean to be negative for people that are, say in, I don't know, New York City or Chicago or Dallas or wherever. But I'd rather you hear the warning and come to your own decisions about what that means. I just don't see people flocking, say, to New York City this summer. So New York City is a huge tourist area. Summer is the peak season, and it's mostly international. So let's just digest that for a second. I don't see a lot of people getting on airplanes this summer. I don't see a lot of people getting on an airplane and going into a crowded space like New York City this summer. And worse, I don't see a lot of people getting on an airplane, going into a crowded Times Square in New York City. And also, it's the epicenter of COVID. So consequently, I think that if you were doing rentals, and I know Airbnb is illegal in New York City and you have to have 30-day minimums. I'm just using this as an example. I don't see a lot of people flocking there. And if I had a short-term rental business in New York City, the kind of things that I just outlined would be worrisome. And I might exit, or I might go to long-term, I might do something else. And you should apply that same sort of framework and methodology to your short-term rental business, where you operate, what you do, and how you do it. Like, who's coming? How are they getting there? How crowded is it? And what brings them there? And so if you think about that for just a second, if you were focused primarily on business travel and in an urban area, I explained to you earlier that I don't think business travel is going to be as important on a go-forward basis, because people can now do whatever it is that they were doing from business meetings and traveling from home on Zoom, just like we're doing this. And that's challenging. Many of us do have W-2 jobs, and we do in fact work. And I did that for many years in my prior life, and I enjoyed the corporate travel. But if somebody, my boss, said to me, "Hey, Richard, as soon as we reopen, let's just call it June 1. On June 4, I need you to travel to a business meeting in, say, Chicago or San Francisco or Dallas or New York City," I might just say, "Well, I don't really feel that comfortable for my own safety and the safety and well-being of my kids. And I spent a lot of time in quarantine and lockdown, and I've come to understand what's really important to me, which is my family, my friends, my health. And I'm not really that as concerned and as grateful as I am for the job. I'm not really prepared to take my life into my own hands to do that." Personally, I don't feel that way. I'm a big traveler and always have been, but I can guarantee you that there are many people that come out on that side of the equation and aren't getting on their plane, even though their boss might want them to. And by the way, there's most bosses aren't even seeking people to do that. They don't have the financial wherewithal to spend on corporate travel, right? Like Zoom is free. Corporate travel, airfare, meals, taxis, Uber, right? Hotels. So I think everyone's just going to sort of say, corporate travel on pause. And what we take a look at, Erica, do you know where there's a, right there, sweetheart. Just that document right there. That's it. If we take a look, and this is what I've been studying, I don't know if you guys can see it. This is a study by a company called HVS, and it's about pandemics in the lodging industry. And what they did was they studied the SARS pandemic. Well, I guess it wasn't a pandemic, but SARS in 2003. And they took a look at what happened in Canada as a proxy for United States travel, because Canada and the United States have a lot of similarities and we're neighbors and so on and so forth. And basically what it shows here is that for the areas of Canada that were not really affected directly by SARS, you did see that consumer confidence decrease and prices or travel went down by maybe 4.7% in the immediate months, and then it recovered rather quickly. And then it took a look at Toronto, which was an epicenter for SARS, and there you saw a broader decline. I don't know if you can see this. But there we saw about a 36.5% decline, and we were below trend for almost 8 or 9 months while the consumer confidence and the comfort level to travel to Toronto resumed. So in a much smaller viral sort of problem, in an epicenter, we saw a rebound or a recovery rather in 8 months. Now, COVID is global and much more serious and much more deadly. And consequently, I don't think that the recovery to epicenters like Northern Italy or New York City is going to be as quick as 8 months. Maybe it's 12 to 18, or maybe it's 2 years or 3 years. But the good news is we do see recovery. People are creatures of habit, and we go back to what it is that we enjoy. We go back to the things that we value. And so people are pent up demand, itching to travel. We may change how we travel. Maybe, we drive. Maybe we go to rural vacation areas. Maybe we go to the mountains. Maybe we go to cabins and we're alone. But the desire to recreate and be with family and friends and loved ones and get away from work and get away from problems, that doesn't cease. Just how we express it may be modified and refined. And therein is the good news story for short-term rental hosts. It's very consistent with a lot of the teachings from prior videos, where I encourage people to be unique and to be differentiated and not to compete on price, but rather to compete on value and experiences, and know your tribe and attract your tribe and speak to the people that you want to come to your short-term rental. Like, that's the opportunity coming out of this. And I just filmed a video earlier today, like I said, coming out in the next couple of, days or weeks, depending on Charles's schedule. But it's basically that, I think Airbnb goes back to its roots, where we become more of a community and less of a massive growth scale rental arbitrage. Take 1,000 units, take a whole building and the exact same unit and just list it. I think that that's going to be a challenge. I think it was a challenging business model before, and it worked until it didn't. A lot of those businesses are no longer with us. Many of them are much smaller. They scaled up really quickly. They raised a lot of venture capital money, and just as quickly as that money came, it also vanishes. But if you're a short-term rental host on a smaller scale, and you're connected to your why, and you've got a cottage or a cabin or a beach house or something that you enjoy personally, while this COVID experience has not been pleasant, and it's probably been very costly as you've seen the revenue go to zero, I hope you have the financial wherewithal and strength to continue to support it. Maybe you're even there during quarantine. I got a lot of different messages and also thank yous from people who wouldn't have had that otherwise, right? Like, they couldn't buy this cabin, the second home, without the short-term rental income. but they were able to buy it because of the short-term rental income. And now they're safe and sound with their family, friends, and loved ones during very challenging periods. And as soon as the world sort of allows visitation again, they will start renting it again. And while we may not make quite as much money immediately, I think over the long term, we're in a much better position because there's far less competition and also consumer behavior changes and so on. So I think this entire short-term rental space moves away from sort of competing with Expedia and Marriott and Hilton and generic hotels. And it really allows us to become hosts and entrepreneurs and greeting our guests, and we go back to community and we differentiate ourselves. And people may prefer to stay with Richard, other people may prefer to stay with Erica. Like we develop our own tribes, and I think there's a tremendous amount of opportunity. And I encourage those of you that feel that way and own these homes and enjoy the hosting experience and aren't all about having 600 listings, but maybe one or two, to start to brand, start to separate yourself from everyone else, start to differentiate yourself, start to create those relationships with your guests when they're in your home, before they come, after they depart. Start to take control of your own business and cultivate those relationships and try and get them to book directly through you on your own website, whether you use our HostSaver tool or another tool, it doesn't matter. Maybe you're great at coding and you just code your own, but do it. Right? Like the time is now to take full charge of your business. So I personally think, based on the information that we've started to see in a couple of different locations rather, that we will start to see summer travel. It may not be in May. It's more likely sometime in June, but I think the vast majority of the locations that I've studied will be open by, say, July. And while we're open in July, it's not going to be a normal summer, right? If somebody comes to my place here in Jackson Hole in July, the restaurants won't be at full capacity. The national parks have already identified that they're going to be operating with limited staff, because normally they hire, say, thousands of people to monitor these national parks that bring in millions of people in the summer. And because of employee housing restrictions, they're not going to be able to hire as many. Instead of putting 4 people into a single whatever cottage wherever they would normally live, each cottage is now 1 person. So they're not resuming full hiring, and therefore the experience will be a little bit different, but it'll still be a great experience and people will come. And I'm getting reservations every single day in a variety of locations. So we're starting to see interest and demand and bookings, and people putting money to work, reservations outside of the extenuating circumstances, so they know what reservations they're making. They're willing to take that risk, but they're eager to travel. And I just think it's important that we start to think from short-term rental perspective. What are we doing to ensure our guests' safety and comfort? And also, I want to plant this seed. I hope this doesn't come, but I will say that the global authorities, the governments, in many ways have shown us their strength in fashions we've never seen before when we're not in crisis or at war, right? Like, we are being mandated to stay at home. We are being told what we can do. We're being told what we can't do. And it's possible that places that are not big short-term rental fans from a regulatory standpoint — I made a video a year ago saying the single biggest risk in short-term rentals is regulatory, and that remains. Many of these locations will view COVID as the excuse to single out short-term rentals or prohibit them or restrict them, or to institute new regulatory frameworks that they believe are safe or sound. And so we talked about restaurants opening at 50% capacity. I want to float this concept for you, and I hope I'm wrong, right? Like, I'm not saying this will happen, but I'd rather everybody hear these things and prepare for these things than just ignore them. And so what is a possibility? What if your location told you you could operate a short-term rental, but you had to have 3 days or 5 days between guests? Well, that is a real problem. And the reason that's a real problem is, on slow season and shoulder season, that may not be that big a deal. That's not when your revenue comes in. You might have 5 days between guests anyway. So it's not really that painful. It's not a lot of revenue. It doesn't have a lot of cost or implication. But what about your busy season, your peak season? That might be when you're at 80% occupancy, and that's when you make all your money in the year. And now during peak season, what if you're restricted by the number of people you could have, and you can have, say, 4 guests in a month, right? The average guest stays for, say, 4 days or 5 days. Then you need to have it vacant for, say, 3 days or 4 days. So your income for the year could be impacted by, say, 40%. It may not be 50%, but it could be impacted significantly. And these are the kind of things where when we start to see governments acting outside of their bounds and singling and pinpointing out what business is essential and what business isn't essential, and you have, like the groomers at the big PetSmart, they're allowed to work, but the lady Linda, who's the groomer, she can't be open. They're picking and choosing. And I'm not saying that they're being malicious. I'm just saying we're learning that we don't have as much control as we thought in pre-COVID era. In post-COVID era, we're going to be told what we're allowed to do and when we're allowed to do it and how we're allowed to do it. And so as short-term rental hosts, I just want you to recognize that the regulatory environment is still really challenging. There are certain regulatory locations that will pinpoint short-term rentals because they weren't fond of them in the first place. And there are bad apples that are happening right now. Every day I see an article about somebody who rented out an Airbnb. They thought they were renting it to nurses or essential workers, and the guest was a bad apple, a bad actor, lied, and they're throwing parties. In this era of social distancing, people are booking Airbnbs in communities, and they're putting a lot of lives at risk, not only their own, but also, the police that come and break up the party, and also the medical frontline workers that might have to rescue people through this pandemic. So there's areas where we're getting a lot of regulatory scrutiny. We've got bad apples that are making it even worse. And I think there's a possibility that in certain areas, what we took as our own civil liberties and our ability to run our own business may be curtailed. So with that, I think I'm going to pause. I know people are just absolutely blowing through. I see, tons and tons of comments and questions here. I'm trying not to read them because I'm trying to help think through all of this stuff. But before we go to questions, I just want to say the following. Short-term rentals, in my opinion, remain completely undervalued, filled with opportunity when done right in the right locations. And I think that there's an opportunity, as I've taught many people since the start of this channel, to be more unique, more rural, more destination, more experience focused. And also you can charge more for those things. But if you're trying to compete in the very plain vanilla generic in a densely populated area with business travel, I think you're going to have a very challenging period for, say, like the next year or 2 or 3. Doesn't mean that you shouldn't continue. It just means recognize that, save accordingly, spend accordingly, and just batten down the hatches. Okay. Do you have questions for me?
I do.
Let's go.
Okay. So, well, a couple of things. When you warned us about the crash back in January, I liquidated all of my stocks.
Yes.
Thanks for the best advice I ever got.
Oh, and is there a name from that?
Ian Peary?
Ian Peary. I'm so glad that you took some action. For those of you who didn't hear Erica, he said the warning that I issued in January about the stock market and the recession coming and so on and so forth. Ian went to cash and thanked me for the advice. And it's my pleasure. Look, I just want to go on record as saying, I'm going to be wrong as often as I'm right, but I'm going to tell you what I know in real time and share with you, and you make your own decisions. But I'm glad it really worked out. It brings me a lot of joy and gratitude to know that I'm making a difference.
Gail Jordan, I followed Richard's advice and lowered my prices 20%. My calendar booked well, and I actually had to raise the prices back up again to slow it down a bit.
Awesome. So Gail just said that she followed my advice and lowered her prices down by 20%. Her calendar filled up really quickly and she got all these bookings, and now she's in the process of raising her prices. And that's exactly what we're doing too. If you're not using dynamic pricing, it's more important than ever because we've never seen this. So I need to have my price low enough so that I'm competitive and I get a booking. But as I start to see more and more bookings coming in, I want the algorithm that sees not just my listings, but like all of the listings and all of my competitors to help me adjust my prices so that I'm more profitable. And it's a huge competitive advantage always, but in the post-pandemic, like COVID era, dynamic pricing, having an algorithm. I'm a big fan personally. What I use is Beyond Pricing, as you all know. But if you're not using it before COVID, the time is now, right? Like we really need to be intelligent, invested, paying attention, and we need to be as profitable as possible, because while we fought and kicked and screamed for every dollar before, the value of each incremental dollar coming in today is that much greater.
Alan wants to know if it's worth it to open a new unique Airbnb now or wait until later.
Okay, so Alan wants to know, is it worth opening a new unique Airbnb now or wait for later? And what I would say is, if you own the property, open it now. I've filmed videos where I say revenue is greater than ready, and that's never been more true. Right now is not a time to have assets that are not pulling their own weight, or that are even worse, dragging you down, right? The analogy that I use with Erica and my team as I think about reinvesting my 1031 proceeds is, I'm looking for cash flow positive, cash engine type opportunities. And many of them that I thought were cash engines before COVID could actually become anchors, like dragging me down. If every single month, instead of it generating $1,000 profit, I have to reach into my own pocket to put $1,000 in to make the mortgage payment, that's a problem. Now, if I think it's a short-term period, and let's say 3 months or 8 months, I might want to own that asset strategically. It might speak to my why, so I might be prepared and willing to carry it for 3 or 8 months, but go in with that knowledge. But if you already own it, then it's important that you monetize it as quickly as possible. And by the way, some of the best opportunities and some of the best trades and some of the best businesses that have ever been launched in the history and personally and in the world come during periods of dislocation, because that's when you have less competition. Most people are on their heels, or they're sitting on their hands and they're not spending. And if you have the strength and the wherewithal and the capability to put fresh capital to work during these crises, you have a huge advantage because everyone else is scaling back.
So on that note, if you believe there will be another drop in the market, would you sell some of your holdings and look to reinvest if and when the market declines again?
Yeah. So the question is, if I think that the market is going to, the stock market is going to retest lows or roll over, would I sell at these levels and look to buy in the future? And I would say the following: it depends on where you, how you operate. So if you're a tactical trader and you're looking to make income and pay gains on that income, then yes, I would do that, especially for the names that have really advanced. We're seeing, I think it's about 40% of the S&P 500 right now is made up of like the 4 top names, which are Apple, Amazon, and I forget what the others are. But I would be lightening up on those strategically to buy other stocks or even those lower in the future. But that said, what I'm going to encourage everyone listening to this and my own personal belief system is, I'm a buy and hold person. So I would not be selling, paying taxes, hoping that the market goes lower. I would just be staying with what I have and looking to add, again, dollar cost average in, I would be looking to add lower. And I think I just filmed, not I think, I know, I just filmed a video on housing prices and what I think happens to housing and prices. And it's a good news, bad news story. In the short term, I don't think very much happens to housing because it reacts slowly. So if we reopen the economy and everything goes on fine, and everything that I just spent the last half hour sharing with you is wrong, which again, I hope I'm wrong. I hope it's easier. Then I think housing probably stays kind of where it is. There's not enough time to correct. But if the scenario that I just outlined for you is in fact correct, and I encourage you to watch the video, it's much more thoughtful than what I'm sharing with you right now. But if in fact what I think happens, anybody looking to expand into the short-term rental market or get into the short-term rental market starting, you probably have a better entry point in say 12 or 18 months. Because if you just think about it for a second, think about your own behavior. If you've ever sold a house, you list it, and I'm just going to pick a number, $100,000. And if that was too high and too aggressive, you sit with it for a month or 2 or 3, and then your broker's telling you to lower it, but you don't want to. And maybe after 6 months, you lower it, $10,000. Now it's at 90,000, and that's still too high. And then another 3 months go by, and then you lower it another 10,000. So it's not for 6 to 12 to 18 months until sellers sort of get the message and say, gee, well, if I want to transact, and by the way, there's a lot of reason that people are natural sellers, that they must sell. You lose your job, you must sell. You move, you must sell. Your family, your kids go to college, you don't need as much room, and you can't afford it, you sell. You get divorced, you sell. I mean, there's a lot of reasons that people sell outside of just money. And so people do have to sell. Those 4 sellers and their price lowering will be slow and gradual. Most brokers that I speak to, and I'm speaking to brokers literally every single day, they tell me everything is fine. They're not seeing price decreases. And they like to point to, the one contract that they sold with sight unseen over Zoom. I'm not buying it. Next question, sweetie.
So, a question that kind of is coming up multiple times, your stance on Bitcoin.
My stance on Bitcoin. Erica says that there's a lot of different people questioning it. And I would say the following. I'm a big believer in blockchain. My belief in Bitcoin is based on the belief of blockchain. And Bitcoin is the vehicle that I believe has the greatest head start and the most likelihood of becoming a digital gold. For the first time ever, I'm actually looking at buying gold and also some of the gold miners. And I've always been, found better investment opportunities. But I will tell you that I am very concerned about the amount of monetary, fiscal, and monetary policies that are happening, not only in America, but in the world. And the consequence is often inflation. But the worst consequence would be deflation. And in both of those scenarios, gold and Bitcoin stand to rally significantly. So if you didn't believe in Bitcoin before, there's a fixed number of Bitcoin that will never be increased. They become more and more scarce. They become more and more valuable every single day. And I would just encourage everybody who has the risk appetite and the wherewithal, just take 1% of your savings and put it into Bitcoin. The most you can lose is 1%. Most of us can withstand a 1% loss and not even notice it. But if I'm right, and many others far more intelligent than me are right, it could be something that really helps your entire portfolio and or your life or whatever. It's a great asymmetric risk return. I would always lose 1% if I could generate 10x or 100x. And I think those are the kind of numbers we're talking about.
How are you feeling about taking your short-term rental long-term?
Oh, that's a great question. I'm so glad. And somebody, is there a name associated? No. Multiple questions. What do I think about taking my short-term rental and going to the long-term rental market? And I would say the following. I'm not a big fan of the long-term rental market. I'm even less of a fan of the multifamily long-term rental market. So if some of you are thinking about getting out of short-term rentals and buying multifamily rentals, I think there's a lot more pain in the multifamily market right now than there is in the short-term rental market. And that's largely because multifamily is a much more advanced, mature, investable asset class. Consequently, there's a lot more people in it, a lot bigger people, a lot more institutional money. And when money comes in and chases a finite amount of opportunity, what ends up happening is there's more demand than there is supply. Econ 101 tells you prices go up. And as prices go up, you get to a point that I like to call price for perfection. And that means you have no more room for any error. If utilities were to be much more expensive, or your vacancies were to be much worse, or people stop paying rent, as we're seeing right now, you don't have the ability to weather that storm because you overpaid for an asset that's generating, call it 5 or 6% cap rate. And consequently, it's a lot more painful. But as it relates to taking your short-term rental, let's say like your cabin and putting it into a long-term rental market right now, look, if you have to do it, then do it. The name of the game is to stay alive, right? So if you have to do it, you have no other alternative, then I'm going to encourage you to do it. But if you don't have to do it, then I'm going to caution you in the following sense. It's never been more challenging to find a good quality tenant. Really good people with really good jobs in really solid professions are losing their job through no fault of their own. So you could have all the greatest screening in the world to get the best tenant in there and check their credit score and look at their W-2. If any of you are applying for financing right now, normally you have to send proof of employment to a mortgage lender, and it's within 60 days or 90 days. You need pay stubs and so on. Right now it's 3 days. They've lowered it that they are going to check before you close to 3 days before. So even still, somebody could be employed 3 days before the mortgage closes or 3 days before they move into your short-term rental, and they could lose their job 3 days later, right? Like, it's that tricky an environment. And here's the really scary thing for those of you that have never had a long-term tenant. Long-term tenants have rights. Short-term rental tenants do not have the same rights that long-term tenants do. Long-term tenants have rights to that property, to that domicile, to the roof over their head. And you as a landlord would then have to physically evict them, which sounds a lot easier than in reality. I've had eviction proceedings occurring in Brooklyn. This is going back 10, 15 years, but it took 8 to 16 months to get people out. The entire time, I'm paying lawyers, I'm paying for heat, I'm paying for water, I'm paying for the snow to be shoveled, I'm paying, because by law, I have to provide that safe environment for my tenant, or I could be sued or liable for any damages. So I have to continue to invest more money, and there's zero income coming in, and I'm paying lawyers, and it's an indeterminate amount of time before the court rules in my favor. They've always ruled in my favor. What I've never known is how long it takes and how much it costs me. And rest assured, right now, the courts are more backed up than ever. With 22 or 25 million unemployed people in America, and more tomorrow unemployed, and more next week unemployed, there's more people that are going to be needing to be evicted. There's no more courts. There's no more judges. So the time frame that it's going to take to get these people through the ordinary pain in the butt process that I would encourage you to avoid at all costs is only going to take longer and be more painful and more costly. And that timeline is drawn out. So again, if you must get somebody in there because that's what you need to do to pay the bills, then do it. Or if it's somebody that you know and you trust, and there's scenarios where I would say to do it. But what I would say is 99.9% of the time, I would rather have a vacant unit than a unit with somebody in there not paying. There's a world of difference between vacancy and somebody who's not paying and is squatting. So I hope that was helpful.
What would you recommend for STR owners that are located next to sports stadiums, amusement parks, concert halls, universities, private schools? Do you foresee people going back to school in the fall?
So this question, I think, is a really good one, and it relates to short-term rentals in and around areas that have normally attracted large groups of people. So whether it's you're near a convention hall, or you're near a concert or a football stadium or a university or a private school or anything like that, what happens to those markets? And what I would say is it's largely dependent, right? So I think that college towns and universities and boarding schools and so on will resume in the fall. Again, it's just a personal belief. I'm not a scientist. I'm not a doctor. I have no medical basis for that. But it is my belief that between the flu season ending and some antibody testing and a gradual resumption of ordinary lives, schools will resume. My eldest daughter, unfortunately, and it brings me to tears, has missed out on her senior year at her boarding school. So she's quarantined when she should be celebrating the fact that she got an early decision to college and looking forward to that and playing with her friends out in the sun in the spring. And she's never going to have that experience. And, it's really, I feel for all of the class of 2020. That said, she's admitted to college, and there's a lot of different things that her mom and I and she are discussing about, is this a good year to take a gap year? Is this a good year to not spend all of that money and instead do something else productive and then resume, say in 2021, when the coast is clear and we have some more clarity? And the answer is, it's a very personal family decision. I think that there's enough demand for some of these universities and schools and so on that even if they're not operating at 100%, they'll be in the 90s. I don't see those going away anytime soon. But I do think that they could be some short-term impact. You know, like we had never discussed my daughter taking a gap year until COVID, but she may take it and her friends not. So I think that that's okay. That said, sporting arenas, convention halls, things like that, I think it's going to take a little bit of time. I still think that they're really worthwhile assets, and I still think it's a really great place to have a short-term rental. But I think for the next, call it 6 to 12 months, you're going to have some challenges in filling the occupancy that you've seen before at the same ADRs, and it might be time to get creative, right? So I'm just trying to think, if you were near a football stadium or something else, like try and get other people in there for other reasons outside of the games. I think that games will likely be played with empty stadiums. Again, I hope I'm wrong.
We have 529 accounts for our kids going to college in 2 to 4 years. Would you sell significant percent or move to cash?
So this is a question about 529 plans, and thank you whoever asked. It's a great question. And just to phrase my answer in context of the question, they are going to college, I believe you said, Erica, in 2 to 4 years?
Yeah.
Okay. So if your children are going to college in 2 to 4 years and you have a substantial amount of money in the 529 plan, and it doesn't have to be a substantial dollar amount, but it has to be substantial for them to go to college, right? So like if they're going to get some scholarship and this is just a portion of it, but without this portion of it, yeah, this is not a time to take excess risk, especially since we've seen a significant rebound. I would not have said that it might be time to go to cash while we were down in the lows in March, when I was asking and encouraging friends, family members, and loved ones, you know, that were more liquid to invest. I think now might be a time to be lightening up. That said, I have a slightly different time horizon. So what I've done with my 529 plans for my children, and it is a significant amount outside of the one that's going to college, maybe in the fall or the gap year. I have younger daughters below that. And I also have a different risk tolerance and income level and so on. But what I actually did there was rebalance my portfolio, where I was selling bonds and buying stocks. And that proved really successful. We had a really nice bounce. I haven't really thought about it since. Again, I'm more of a buy and hold type person. But yes, I think the risk reward in stocks today is more skewed towards downside versus upside.
How do you think STR in landed house, low density suburbs will fare compared to multifamily units in dense cities?
What was the question?
How do you think STR in landed house, low density suburbs will fare compared to multifamily units in dense cities?
So the question is about low density short-term rental units in suburbs versus more congested urban areas. And I think I answered that before, but basically we are seeing in early preliminary data a real change of consumer behavior where people are gravitating more towards that rural and away from urban. In the video that I just filmed, without sharing all the punchlines with you, I think that it's quite possible that we have a bifurcated market where people are spending more and paying more, and we don't see a dip in housing prices for certain rural or suburban areas. And we see the opposite, where we see pain as people are exiting, say, very congested multifamily high-rise buildings and so on. I mean, think of yourself, like, I'm not really interested in going to live right now. I just fled, actually, New York City, but I did so for a quality of life perspective. That was pre-COVID. I just didn't understand how much money people were willing to spend and sit in traffic and ride in elevators with total strangers and like all that. I made a personal quality of life decision. But now, like, I'd be scared to do that personally. I wouldn't want to do that. And I wouldn't want to do that today during COVID. And I don't think I really want to do that a year from now. So the question is, are people thinking similarly? And here's the thing about housing prices, and these sort of trends and demographics is we all very much rely on past behavior, past pricing, past experience. And while that didn't exist in the past, that becomes our new norm today. And as more and more people, like if you think of yourself, let's say you live in New York City and you have a great job, but it turns out you can work remotely via Zoom, and you just lost your best friend's family. They just moved to the suburbs. And then 2 weeks later, another family moves to the suburbs. And then 2 months later, another family moves to the suburbs. And within, let's say 6 months or 9 months, it turns out that all of your friends have moved. And again, I'm not predicting that, but I'm just hypothesizing. How committed are you going to be to living in an overpriced city with poor quality of life if you no longer have friends, family, relatives, restaurants, services, and it's super expensive? And by the way, in those areas, taxes are going up. They have the highest rates of unemployment, and consequently, they're going to have to increase taxes. So I've had a big macro trend in theory and in all my investments and in my own personal life away from high tax states, which tend to be on the coast, New York and California, towards tax-free or low tax states. And again, if you recall what I said earlier in this this live, COVID is an accelerator. It's not changing anything. All it's really doing is bringing it to the fore and making us react in real time and more quickly. And so this trend where I think states that are in trouble are taxing more and becoming more socialist, that's going to continue at an accelerated pace. And those states that are, say, less tax oriented are going to benefit even greater and faster. Another question?
Yes. How true is it the banks will be asking for 20% down to purchase a home? How can we prepare? I have a house with no mortgage.
How true is it that they're going to ask for that? Okay, so this question relates to mortgages and housing and purchasing. And again, I'm in the process right now. I closed on a significant asset on March 2nd, selling in New York City, and have been in the process since March 2nd. As grateful as I am, by the way, I think that the asset that I sold in New York City is probably worth 30% less today than it was on March 2nd. If I could get a buyer, right? Like it's only, I would only be asking 30% less, but I might not have a buyer. So I'm in the process right now of having to reinvest. It's a really good problem to have. The proceeds from that sale and all the gains and tax deferred via 1031. And I can tell you I have near perfect credit. My business partner has near perfect credit. We do quite well on our assets side, and our balance sheet is really strong and our income is strong. And like we're the perfect people historically to borrow. We've never been turned down for a loan individually or together. And yet we can't get financing right now at all. A lot of the deals that I've broken is because I can't get the financing right now. And so the trends that we're seeing are these banks that are in forbearance, right? There's 22 million people who are presumably not paying rent, mostly to multifamily buildings, mostly in dense city areas. They're not paying rent. So those multifamily investments and investors are getting hurt. And then there's also plenty of people in those same locations that own, and they're in forbearance because they too got laid off. And so the banks that would be loaning you money are worried about their own mortgages that they originated over the course of, say, the last decade. And many as a third of people are in forbearance and not paying mortgages. So just put yourself in that place. Let's say you loan money to 10 different people and 3 or 4 of them weren't paying you back. How eager and excited are you to go loan money to someone else who might lose their job tomorrow? So consequently, what we're seeing is LTVs, loan to value ratios, are going lower. You have to have more money. In the past, I could get a loan with 80% borrowed, 20% equity. Today, it's more like 65. I can only borrow 65%. I need to put down 35%. And that's if you can get the loan. They're requiring not only more money down, interest rates are actually going higher, even though the Federal Reserve is pumping all the stimulus in. The banks are sort of hitting the brakes, and the requirement for FICO scores and creditworthiness is increased. And I said earlier, there was a lot of lending in the non-QM market, which means that they're underwriting the income of that multifamily building. They're underwriting the income of that short-term rental, not the individual, right? And now all of those mortgages are gone too. That's not even available. It doesn't matter who you are. So I think mortgage tightening is going to have a deleterious effect on housing prices and the ability for people to buy homes.
What if, let's see.
Should investors purchase gold as a safe haven or hedge against inflation? I think that that's for the first time in my life, I'm saying yes. And what I would personally do is I would split some between Bitcoin and gold. I'm not a huge fan of gold. The storage costs, you can't really transport it easily. And it's not even particularly finite, right? Like we don't know how much is in the ground. Whereas Bitcoin is instantly transferred digitally. It takes a moment's notice. It's open 24/7. And there is a very definitive finite number of Bitcoins. I think it's 22 million.
What are your thoughts on if you have the option of pulling out money from your 401k? Let's see.
By the way, while Erica's reading the questions, I just want to thank everybody for these questions. They're really helpful. Whatever questions are on your mind, rest assured there's other people here, and we have hundreds of people both on Zoom and on YouTube. And so I appreciate it. And this will, hey, Bo, buddy.
Hey, come here.
Bo's getting a little concerned. He thinks Bitcoin over gold. But my point is this will live in perpetuity out in the internet, and people that aren't watching us in live per se will watch us tonight and tomorrow. And so it's really helpful, and I appreciate the questions. And I just want to give a quick shout out and thanks to you guys.
If you have the option to pull out funds from your 401k and pay no interest or penalties for 3 years before you have to pay it back, rather than leave it in and take the hit.
So somebody's asking about whether they should take the 401k opportunity that the US government has allowed, or basically you're borrowing money from your 401k penalty free, and then you have to you have to replace it back into the 401k. And here's what I would say. Now's not the time to get cute or fancy. There's plenty of opportunities without getting cute or fancy. Getting cute or fancy is sometimes how you get in trouble. And what does that trouble look like? You know, one of the things that I would say is you never want to finance a long-term asset with short-term money. That's one of the reasons that rental arbitrage doesn't make a lot of sense. That's the reason that WeWork has blown up effectively. They're the single largest tenant in New York City, by the way. Just think of that for a second. WeWork has more office space in New York City than any other company ever. And their business model is blowing up. So like, think about the pressure on corporate office space in New York City when the single largest tenant isn't paying their rent. And so the reason I bring all that up is if you need that money from your 401k, then I suppose you should do it. But if you're just doing it opportunistically, don't. And the reason I say that is we don't have much visibility about the next 3 weeks, much less the next 3 years. So while you think you could repay it right now, because like based on what you know today, it's a good opportunity, it's a good lever to pull, you can take the money out, you can invest it, and you can make some money. The reality of it is we don't know where we're going to be in 3 years. And what happens if you, God forbid, lose your job between now and then, or one of your family members falls ill and you can't repay it? What are the repercussions to your 401k then? So we can't assume that everything will be fine. And I'm in a position right now for this 1031 reinvestment that I keep referencing, where I can't get the debt that I need. And the IRS mandates that you have as much debt after the 1031 as you did before. So you have to replace the same amount of debt. Well, I can't really get that debt very easily. So what I can do is I can get a bridge loan, which lasts 3 years. And then the concept is between now and 3 years from now, the world normalizes and I refinance it and I get a permanent loan. But I don't like that bet because I don't want to lose my equity or my assets betting with no knowledge that the world normalizes in 3 years, right? Like that's just not a worthwhile risk for me to take. So if you must do it, then do it. But if it's optional, or you're just trying to get creative or fancy or invest and be opportunistic, this is your retirement. And I want you to have a long, healthy, happy retirement where you're not really stressed about money. And this could put you in a bad jam.
Do you have any thoughts basically on Airbnb versus VRBO, some of the other sites, going out on your own?
Yeah.
Do you think Airbnb is done for?
Okay, so the question is, what are my thoughts on OTAs and platforms, Airbnb, VRBO, going out on your own, doing it with your own website? Like, what's the future look like for this industry, and how do people book? And I would say, and the final question I think this individual had was, do I think Airbnb is done, right?
Yeah.
Or like in trouble or something like that. The answer is, I think that you should be on multiple platforms, because it's not so much about our preference as hosts. You want to meet the guest where they want to be. So in vacation rental markets, where I think there's a lot of opportunity on a go forward basis, maybe even more opportunity as individuals and consumers adjust their behaviors, right? So like, for instance, if people used to like to go to, again, New York City on vacation, or they wanted to go for 4th of July or whatever, see the Macy's fireworks display, I think a lot of people that would have gone to New York City are going to go to the mountains or the beach or a cabin or a lake or something else, right? They will recreate, they will take vacation, they'll just change their location. So I think there's an opportunity in these areas for increased, outsized opportunity. That said, vacation rental by owner and or HomeAway, which is actually owned by Expedia now, just raised $3.2 billion of debt and equity. So like, they too are hurting. They are much more of a transactional platform. Expedia, the parent company, is much more transactional. They have a lot of hotels, but VRBO is a traditional stronghold for places that do these vacation rentals by the beaches and the mountains. And by and large, Airbnb tends to be more urban and younger and millennial and so on. I mean, I'm obviously painting this with a broad paintbrush. It's not exactly true, but orders of magnitude, it's about right. So if you have not been on Airbnb, even though I've suggested you do it 1,000 times in 1,000 videos, now's the time to go on Airbnb and also VRBO. And by the way, if you're on only VRBO, just go ahead and throw it on Airbnb. We have plenty of time. We're self-quarantined. You should be on multiple platforms no matter what, because I don't have great visibility on who survives and who doesn't. I think we all survive. I think Airbnb does just fine. I think Expedia does just fine. But I still maintain that the ultimate goal here is kind of like what I had decades ago in the Hamptons, when I used to rent out by the season, and then people started cutting it down and you started renting by the month of August, the month of July. You want to develop personal relationships with the guests that you know love your home, love your location, love your pricing, take good care of your home. And you want to book direct as much as possible. Not only do you save money, but there's less wear and tear, there's less damage, there's less overhead, there's less like headache, right? Like, one of the things that Airbnb did was create this platform where we had this like-minded community, by and large, forgetting about all the people that took advantage and lied and had house parties. But it created a place where people could come together and transact, but it was really anonymous, right? Like, we couldn't share phone numbers and we couldn't share emails and we couldn't communicate off the platform. And I think ultimately we as hosts want to own our own business, own our own relationship, be able to email. Like, think of yourself right now. If you have vacancy, let's just say in your community, and your community is called ABC, ABC opens up for Memorial Day. May 25th is when it's open, and you don't have any bookings right now. How nice would it be to email 25 prior clients who've stayed with you in the summertime and let them know, COVID's over, we just reopened. I'm putting on sale, the first person who takes this block is getting a 25% discount. Like, that's what running a business is all about. And you can't really do that on anybody's platform, but you can do it if you have your own website. So you should have your own website. And again, if you're not technically minded, Hardik, my man Hardik, has created HostSaver, which is what we use, and hundreds of people in the short-term rental university community are using now. And what we see is more people signing up more quickly. We've done no promotions, no advertising, no emails, nothing, but people are doing it on their own accord as they start to understand the importance of having this. And we're starting to see more visits to their websites. And most importantly, we're seeing more and more bookings every single day. So the volume of transactions from short-term rental university hosts like yourself that are now booking directly via HostSaver is increasing daily. And that's really encouraging and really exciting. And I believe that's the end goal. Again, whether you use HostSaver or you make it on your own, doesn't matter to me so much. Just do it.
What are your thoughts on areas of Florida?
Oh, it's pouring.
I know.
Um,
Due to low taxes, beach, and less international travel, I'm very bullish.
Yeah, I've been very bullish in Florida for a long time, with the exception of hurricane risk. But that's an area that I've spent a lot of time looking. I've got a couple of properties under contract, and once I get my financing all closed, I will be expanding into Florida. I've also had a couple of properties that I'm really drawn to, mostly for quality of life and connecting with Erica and my wife. Come over here and I'll share. Guys, first off, let's welcome the beautiful and gorgeous Erica. But the reason that I'm welcoming her more than anything is, if you can see, it's a little delayed. So here we can see it, but once we see it over here, California. So from our why and from where she is, California's got a really great quality of life. And so we're drawn to it. I think there's a lot of opportunities, but you know what? They're super aggressive in terms of taxing people and trying to make people residents, and then taxing all of your worldwide income as California-based income. And I'm just not interested in playing that game. So I think that the answer is, as investors, we need to take a more macro look at the world and where we see opportunity and where we see growth and where we see shrinkage and where we see, problems. And taxes, believe it or not, although it's an honor and a privilege to be an American and pay taxes, is a real challenge. We're getting to the point where the most wealthy people in California and in New York are between city, state, and property taxes and not being deducted and so on. They could move to like Sweden and pay less in taxes and have education paid for and also all their medical care paid for. But if you live in California or New York, you have the privilege of paying those high taxes. You get no education and you get no health care. You have to pay for those separately. So it's not sustainable. And consequently, I agree with whoever asked about Florida. I think Florida is a really interesting state with a lot of opportunity, especially for the short-term rental market. I think there are some places that are kind of crowded, and I haven't really looked at them personally because they don't appeal to me or my why, like Orlando. And Orlando has a real challenge if Disney doesn't open soon. There's going to be a lot of short-term rentals and a ton of hotel rooms that are vacant temporarily, right? Like, it's not going to happen forever. Disney's going to resume. If you watch that video I made about stocks that I like, I still like Disney quite a bit. It will be an important part of our life on a go-forward basis, but that doesn't mean that I would be rushing to buy in Orlando today. That said, if a lot of these short-term rental people that got attracted because it was quick bucks or they scaled really quickly became forced sellers and we saw the market in Orlando dip, then opportunistically it might be a great buy. But today, I don't think it is.
We are both fans of Tesla stock. Do you believe Tesla stock will drop back down similar to March 18th, around 360 a share due to COVID? The company is awesome and talking about possibly making home HVACs and million-mile batteries. They're very forward thinking.
So the question is about Tesla and the valuation, and do I think that we'll see another drawdown into the 300s like we saw in March? And the answer is, I have very long-term view on Tesla. Tesla's not a short-term trade for me. So what I would suggest is, if you have money to add to Tesla, dollar cost average in. If you don't have exposure, start and then just set up a timeline and think about these dollar cost averages over, say, the next 6 or 12 months, right? I think the negativity that we're seeing in terms of the reopening timeline and so on isn't going to play out overnight. We've already had that massive drawdown and that fear-based panic in early March. So now it might be a more normalized lower grind as opposed to just a free fall, and just try and scale in. Do I think we'll see in the 300s? on the one hand, I would like to say, I sure hope not, because that would be a bad world to live in. On the other hand, for me personally, I'd love to see that so I could take advantage of it. But right now, I'm just going to continue dollar cost averaging in, as opposed to trying to call the bottom or wait. But what I am doing is continuing to lighten up. I did add some risk assets when I was saying it was a good buy in early March during that free fall when the VIX spiked into the 80s and we saw record high volatility. That's when you want to be buying, when there's fear in the streets. Now that we're at or near, like the NASDAQ 100 is positive on the year, which doesn't make a lot of sense to me. So I'm not really adding NASDAQ exposure at these levels. I think we're in a world of hurt. And to say that we're, positive on the year doesn't make a lot of sense.
Can you explain can you talk about STR experiences? How important are they in the COVID world in urban and suburban centers where people will be looking for unique, low density experiences, thinking ahead to people wanting to visit a city, but then thinking about what they might want to do once they get there?
So I guess the question is about Airbnb experiences and what do I think the outlook is? I think it's a great concept, and Brian Chesky has invested literally billions of dollars to make it a success, and it is yet to be a commercial success. And I also don't think it's very successful for the Airbnb experience hosts yet. But I do think it's a really important question. Not necessarily that you're going to be an Airbnb experience host, but how can you create a better experience for guests of your short-term rentals, whether it's through a more modified guidebook? Your dad, Erica's father, did something which I thought was really creative and worth sharing with everybody. He's taking this quarantine downtime, and I don't know the exact extent of it. I'm making some of this up or paraphrasing or whatever, but like taking, say, drone photos and then putting together flags on the photos of where, whatever, the entrance to the lake is, the entrance to the bike path is, where you go cross-country skiing, little bit of a write-up, creating a more curated experience so that somebody who comes to your home, and besides the normal guidebook, right? Like we've all done that. But think of Guidebook 2.0, where you're now putting yourself in their shoes. We had a similar experience in Hawaii. We did a video on it where this person said, if you're staying at my short-term rental for 3 days, here's what I would do. Day 1, have breakfast here, then go on this walk, then take the canoe, like whatever. If you're staying here for 5 days, here's what the itinerary looks like, right? And so you can create these experiences in your own short-term rental at no cost to you, by the way, but that adds so much value to somebody who's just arriving at your place and doesn't necessarily know what to do or where to get started or where to shop or anything like that. And I think that becomes much more important, right? Like as hosts, we're really going to be much more hosts than we were a provider of lodging. Where Airbnb was going, unfortunately, until it got redirected and corrected down into the more host and community path, was about scale and volume and size, and they were trying to go public, and they were catering to a lot of these businesses that don't make a lot of sense, like rental arbitrage at scale, hundreds of units, thousands of units, right? Generic, and it's just really lodging, right? That's really more like a competing with a corporate housing, competing with a hotel. Where I think the beauty of the short-term rentals and what attracted me initially and what I've taught from day one and where I think the opportunity remains is to be unique and to be individual and to have personality and to care and to welcome people into your home and your community and do things that a hotel doesn't do, right? And so like that's our strength. So I do think that the opportunity to have more experience-based stuff in and around your short-term rental will differentiate you from the guy across the street that's lazy, bored, doesn't know what to do, is not following this channel. And the time to differentiate is now. Outdoor enthusiasts.
Right. Like, so for example, like dad is appealing to all of the like outdoor enthusiasts
Right.
that want to get on the water, that want to
Right.
go for a bike ride, who want to go, play in the snow. Same with
Yep. So
North Carolina.
So what Erica is saying, for those of you who couldn't really hear, is really, she's saying about outdoor sports and outdoor enthusiasts, but I think the broader topic is more about knowing your tribe, right? Like attract the people to your short-term rental that want to do the things that your short-term rental enables. And if it's in my particular case, in our particular case, we're really avid outdoors people. And so like those are the people that we want to attract here, and we want to enable them to go do amazing things, whether it's bike riding or hiking or skiing or whatever. And so that's the language we speak. That's who comes and stays here. And I think that's going to continue. And in fact, it could even get bid, meaning like more people want to do it and they're willing to spend more money to do it because it becomes more important to them to do it, since they've, sanity checked their reality, and they've sort of dialed in on the fact that recreation with loved ones and family and friend is more important, because we only live once and we don't know really when that changes, like when our life ends. There's just pandemic or virus or fear. And so like people will come to their rational place if they can afford it, and many people can continue to afford it. I'm getting reservations every day where people say, now's the time. I've always been meaning to go to Yellowstone. I've always been meaning to go to the Grand Canyon. I've always wanted to go whitewater rafting. I've always wanted to go whatever. It could be anything. To this art show. I've always wanted to go to, it doesn't matter. But the stuff that people have on their bucket list, if they can afford to do it, they're going to prioritize it. They're going to make more time and spend more money on it, because they were kind of like, wow, I just got a wake up call. I thought all was good. I know I'm healthy, but that could change in a minute.
Currently have a property under contract, but thinking of keeping some dry powder for upcoming deals in next year.
Yep.
And backing out and losing escrow. Thoughts?
So the question is, and this is a really good question and hopefully helpful to many. This person has a deal under contract and they're thinking about exiting and losing the escrow in order to keep dry powder for future opportunities if, in fact, I'm right and the housing market does decline. And so the question is, what do I think about that? What I would say is the following. It depends on the community and it depends on how much the escrow is. So I've done deals in the state of North Carolina where the escrow is $1,000. I've done deals in, I think it was California, where the escrow is 3%. Now, 3% of, call it $400,000 isn't a ton of money, but 3% of $3 million suddenly becomes a real amount of money. And then I've done deals in other states like New York and other places where the escrow is 10%. So I can't really answer that question without the specific knowledge of, one, what's at risk, and then what we need to do is weigh what's at risk versus the reward. So if you think you're going to walk away from, I'm just picking a number, $10,000 worth of escrow, but you have the opportunity to buy something a year from now, $50,000 less, that might be a calculated bet. But if you're going to lose $10,000 and you only think you're going to make maybe 10 or 20,000, if you're right in say 12 or 24 months, that probably wouldn't be something that I would encourage. But what I would do is I would go back to the people, and I've done this in multiple occasions, and I would say, it's time that we really sit down and we renegotiate. The world is a very different place, and they may or may not be willing to do it. If they're smart, they would go through and renegotiate down a little bit. And the reason is, and what you should tell your broker, and I can't tell you how many bad brokers there are out there. Hopefully you're working with a good broker. But the reason that they should do it is because the likelihood of finding another person like you who can get financing, who wants to buy it in the near term, is unlikely to happen. In fact, one of the deals that I walked away from, the broker, I don't know what, they were trying to tell me how the seller was not interested in renegotiating, and they had so much financial strength. And by the way, this was like in early March. So the world was really dislocated. The stock market was crashing. And I just said, look, I'm uncomfortable. I think we need to renegotiate, or we need to do this deal slightly differently. And what the broker came back and told me was, the seller's very strong financially. In fact, they're in oil and gas and they're in Canada, and like they don't really need this asset or this income or anything like that. So they're not willing to negotiate. And lo and behold, I continued to follow the property, and wouldn't you know it, they decreased the price. They basically did everything that I asked for. The broker never even thought to call me back. So I called the broker just to get caught up on what's going on. And then not 2 weeks after he and I spoke, oil went negative. Canadian oil sold off massively. The dollar's strengthening, the Canadian dollar's weakening. So all of these false pretenses that are based on like past stuff don't mean that they hold true in the future, right? Like this person who's in oil and gas might now be a motivated, desperate seller, no matter how wealthy they were before, right? Like what they knew and they were comfortable with and they deemed safe suddenly became unsafe, very risky, and maybe now they're motivated sellers. So rather than walk away, I would try to renegotiate.
How is your real estate development going, and how is the crisis going to affect home building, and how will that evolve?
So the question is about home building,
Yeah. How is
construction, financing.
how is your
So that's a great question. I can only speak for myself and my theories here, but I'll give you a personal example. I currently have a $10 million line of credit, open, approved, ready to go for construction projects. I'm using it in the Outer Banks of North Carolina. And I had a few other contracts under place for my 1031 extension where I was going to draw down that line of credit. Here's the thing about a line of credit. Until you draw it down, it's just theoretical and on paper, and it can be removed immediately. I recall in 2008 when 2009, when I lost my job. Before I lost my job, but I saw the writing on the wall in terms of the world and the economy and so on and so forth. I had a home equity line of credit on the asset that I just sold, and I took the whole thing down and I just left it in cash. I was so worried about the world. The FDIC, the Federal Depository Insurance Company or whatever it is, insures each bank account for $100,000. And I had a multiple of that, and I placed it in that many multiples, different banks. So I actually went and opened banks and put $100,000 in, or maybe I think it was 100,000, but whatever it was, I didn't want more than the FDIC insured amount in each bank. And I actually opened up bank accounts so that I would have FDIC insurance on all of my money. And the reason I share this all with you is this impacts housing starts and construction, because right now I would be under construction on 3 or 4 different projects. And in fact, I'm just on the tail end finishing up the Outer Banks, but I can't start a new project. I anticipate that my line of credit and all of my, competitors, peers, whatever, everybody who has lines of credit for construction is on hold, is on pause, but I anticipate that that will get lifted. When I spoke to my mortgage broker, Adam at Host Financial, he basically said that the reason that they're on hold right now is that they're worried that there are no buyers. So what they don't want to do is loan money against new construction if the housing market, in fact, doesn't have any buyers, right? Like, we don't need more inventory. Nobody wants to finance a brand new home if you can't sell it. The reason that people finance brand new homes is when there's a strong demand, we're in a strong economy, and there are a lot of buyers. Now, from a macro perspective, we're at historically low levels of inventory. So there is natural demand for housing and homes if and when the world normalizes. But the key words there are if and when, and we don't know when that is. So lines of credit have been paused. I think housing starts are slow or paused. They will resume. I just don't know when. I'm hopeful that it's in the next 2 or 3 months because I have a lot of projects that I'd like to continue on. Somebody here is asking about construction. My line of credit, it works for both remodeling and ground up construction. Doesn't matter. I can't access my line of credit for either.
Richard
Kiyosaki.
Thank you.
Yep.
Was interviewed and said he believes the U.S. stock market is going to go horizontal, similar to a few other major economies due to baby boomers, a lot of people about to retire and sell a lot of stocks. What are your smart financial thoughts for many of us who are making the stock market to make 20+% towards buying STR homes? If Bitcoin's 1% of our portfolio and the stock market goes horizontal, hopefully doesn't happen, where is a good area to make money for buying STR homes?
Okay, so the question is, where do we make a lot of money to fund our growth and so on? And what I would say is, the stock market is not a place where you want to be investing to make current income to fuel growth. I very much believe in the stock market in the long term over market cycles, which means you have to buy and you have to hold. I think that the best way to generate income is from running a business, from current income, from doing things that, you put in some labor today and you get some immediate output, and then you can take that output and you can reinvest it into short-term rental homes. But just as easily as you can make money in the stock market, you could lose money. So I wouldn't take capital that you need for, say, funding your growth or your kids' college education or anything like that in the near term, and make a bet on where we go. It's very risky in normal markets. It's even more risky in these markets. All you have to do is take a look at the VIX, which is the volatility index, and you'll see that the professionals are saying that this market is very hairy, has a lot of risk, and they're pricing all of their options appropriately. So I don't have a good answer where to make money. What I would say is make money in your given profession, trade, knowledge. If you have to work more hours, then you work more hours. If you have to open up a second location, like whatever you need to do that. But don't think that there's a lot of free money, easy money in the stock market. Even Bitcoin, I think, you could easily lose money on Bitcoin. So and by the way, there is a time to be aggressive. I'm just not sure that we're there yet now. So I was cautioning people that the time to be aggressive was not in January, because we were so late stage in the cycle. It was the longest bull market we'd ever seen for 12 years. And I was saying things like winter's coming and like keep your powder dry and don't get overly leveraged and just be cautious at the top. We've had a massive correction. And when we were down in middle of March, I was saying buy, 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 buy. Now that we're in the middle of April, that opportunity is gone. So right now, there's not a lot of like really clear opportunities where the risk and reward is in your favor. That said, as these things play out over the next couple of months or even a year or two, there will be another opportunity in my best understanding where there will be more pain, more people that were unemployed didn't get back to full employment sooner. By the way, there's a lot of people who are on unemployment now who are electing not to go back to work, right? They're between the $600 on top of the unemployment, they might be making more money with less labor. And so like they're not running back. And so if you're a business owner and you laid off people or you furloughed people and you're giving them good news, hey, I just got PPP and come back to work, and you're being told, no, I don't want to come back to work, I want to stay on unemployment. As a business owner, now you're hampered. Now you're trying to like interview new people, train new people. So the whole like turning the light switch back on is not as easy as it sounds, and it could take a lot longer. And as those businesses falter, as that real estate gets sold, as people exit those opportunities, there's likely a better opportunity to get up at bat and swing away. Right now, I just want you to get to base. We're not swinging for home runs. I just want you to like bunt, get on base.
How you doing?
How am I doing? I'm great. We have a lot of people watching, and we've been going for 95 minutes.
So just checking in.
Yeah, no, I'm good. Let's just see here. But we are gonna wind this down only because
Okay.
we have.
This is gonna be our night.
Yeah, exactly. Let's see here. I appreciate the information you're sharing. Lots of good advice. I've had 2 come through full price offer in 24 hours. Took the offer and closed. 2 weeks later is when the COVID-19 regulations rules kicked in. Yeah, sometimes being lucky is more important than anything else. And I'll express my gratitude for closing on my single largest transaction I've ever done in New York City, which you've heard me share all of the post-COVID scenarios for New York City. I closed on the single largest transaction I've ever done on March 2nd in New York City. Now, I was trying to sell that for a couple of years. It took that long. The market was depressed and going down, and we kept lowering prices. It took us a couple of years to get to a market clearing price, and I'm really glad that ultimately we closed. And I saw the writing in the wall with the COVID in more like February, and I was really worried that we were going to be delayed or renegotiated or stalled on the closing. And thankfully, we closed. But that was just good fortune or faith or somebody watching over me and my partner and so on, my kids, my family. And for that, I'm very, grateful, and I don't take any credit for it, but sometimes being lucky is more important than anything else.
So there's a number of people that are really curious what you think about like the PPP and the stimulus and like just, I think just the housing market and,
The economy at whole. Yeah.
Yeah.
So my man Dom, these are Warby Parker. And the coolest thing about these is when you're an old man like me, up here is clear. And then somewhere down here is my reading glasses, which is why when I'm reading stuff, you always see me looking up because that's where it is. So it's not that I'm so like strange. It's just I can't read. You know, I'm an old man. So I got to look up. You look at my nose. It's all cool. But they're Warby Parker and they've got this graduated, whatever, bifocal or no bifocal. But most importantly, they also turn into sunglasses based on the number of not number, but on the amount of sunshine and stuff. So like literally I live in these things because they allow me to see and to read and see distance, and they turn into sunglasses and it's wonderful. So Warby Parker, again, you know, like a company that disrupted the traditional way of buying glasses. And there's a lot of opportunities and things like that. But Erica's question here, and I think we're going to take this one and maybe one more.
This is a big one.
Yeah, this is a big one. It's sort of about the economy and PPP and the stimulus and housing and what does this mean, and what do we think about it all? And I would say the following, you know, when I keep referring to the fact that these are unprecedented times, what that actually means is nobody has any idea. Anybody that you're listening to, whether it's me or an economist or somebody on TV, we're all just using the most information that we have gleaned from the past to prognosticate on the future. But that's very variable. And that's why you have discrepancy. Somebody could say fair value is here and somebody else could say it's over here. And we don't know. We don't know. What I will share with you is that when we've seen economies print this much stimulus and liquidity and inject it, it solves the immediate need, right? Like the patient that's bleeding, we stop the bleeding, we save the life, but then we don't know about the quality of the life thereafter. And as I said earlier in the live event, I think that it's much more likely to impact my children's generation than it is mine. But there's a lot of people that should have some real concerns, especially people that are my age and older. Things like Social Security are really questioned right now. They had real deficits and concerns around pension funding, pension liabilities. So for any company, if you worked for a school or a county or a policeman or an educational facility or anywhere that the pension was really like one of the main reasons that people were drawn to that line of work, the certainty that I could stop working at a certain age and retire and have a quality of life. Those were all based on models that no longer exist today. Those models are broken. So basically it suggests that out of every one of my paychecks, a certain amount of money goes into the pension. And then the modeling says that that pension is going to be invested in bonds and some small portion in equities, and it's going to generate a return. And maybe that return would be, let's say, 5% compounded over the next 20 or 30 years. Well, I don't need to share with you that we're in a zero interest rate environment. Interest rates might even be going negative. It's not only here in America, it's in the world. We're in a zero interest rate to a negative interest rate environment in the world. And there's not a single pension fund who modeled zero interest rates. Everything was modeled off of compounded rates of return. And those are incorrect. Those are factually broken. And so this entire pension fund system, Social Security system, that's a huge question mark. I would not rely on it. I would take it, I would hope, I would pray, but I would also take matters into your own hands and do something about it now. So, long way of saying the world and the economy is in a very challenged environment. I think what the federal government has done in the US and in many other countries was ultimately massively needed and is actually, to their credit, as imperfect as PPP is, and the wrong companies are getting it and individuals aren't getting it, and there's all this authoritarian, you know, you're an essential business and you're not, like there's all sorts of problems, and I'm not blessing anything that we've done. All I'm saying is trillions of dollars, hundreds of billions of dollars were going in to stimulate the economy. They actually did it relatively quickly, relatively well, imperfect and unfair, but relatively well at getting the money out there really quickly. But those implications, like what that means for businesses and education and Social Security and pension funds and the value of the dollar and inflation and or deflation, We won't know for some period of time, and that's measured likely in years to decades. That said, for my belief of what that looks like, being inflationary or worse yet, deflationary, I'm investing in gold and Bitcoin. Gold, again, just to reiterate, is the first time I've ever even considered it. So like it's a departure from my norm, but these are unnormal times and they call for unnormal decision making. And, you know, that's what I'm doing personally.
Are you recommending that we draw down our home equity lines or personal lines of credit given the circumstances?
Yeah. So the question is, do I recommend that people draw down equity lines of credit given the circumstances? And again, I can't make that decision for you. It's really very personal. Meaning, if the drawing down of the home equity line allows you to live another day, then yes, you must do that. If it's just like I described in 2008, when I drew it down because I saw that the world was like in a really bad position, and I just wanted the comfort and safety of knowing that I had, in that case, you know, hundreds of thousands of dollars in a variety of different banks, so that like if it got worse, then I had access to it and I wasn't worried that the home equity line of credit would be removed from me, like what happened to my construction financing, but I could afford to make the monthly interest payments. If you're in that position and you just want the sleep at night, safety and comfort, I'm basically sharing with you that a home equity line of credit, the right to draw that down, is very different than you actually having it in your bank. So if you're worried and you have a home equity line of credit and you can afford to make those monthly payments, let's say it's $100 or $1,000, then I would suggest you consider doing it. I wouldn't do anything risky with that money. Again, now's not the time to like be swinging away. But if you're worried about sort of the future and it would help you be more calm and rational and sane and view the opportunity for what it is versus what you fear, because you now have an extra $50,000 or $100,000 in cash at your bank, then yeah, do it. The main thing that we need to realize right now is that we're all operating with tons of uncertainty. Uncertainty leads to fear. When you're in a fearful mindset, you do things that are extremely irrational for your long-term success. What you do when you're in a fearful environment is you protect yourself and you live smaller and you make small decisions. And what I'm saying is, through these dislocations, time and time again, some of the best opportunities you may see in your lifetime are on the other end of this. So if you can draw down your home equity line of credit and you can make that monthly payment and it's not really adding stress to you, but in fact, it's relieving the stress, then yes, I personally took a lot of comfort knowing, again, that I had hundreds of thousands of dollars spread across a lot of different banks that were FDIC insured. But that was also a really panicked time, right? I also recall then, I didn't actually do it, but the joke, even though it wasn't funny, on Wall Street at the time was you need two investments. You need gold and guns to protect your gold. And if you think that way, then yeah, go ahead and shore up your financial cash reserve position so that you can sleep at night, so that you're not worried, so that you're not living in fear. And while we may have uncertainty, you're at least sane, rational, thinking clearly and objectively.
Or there are people who are laid off and not going back to work to become a full-time entrepreneur.
Yeah, well, that's the other thing. You know, I got laid off in 2009, the first trading day of 2009, and that set me off on this entrepreneurial journey. There's 22 million people, many of whom, the vast majority of whom, are high quality individuals with great skill sets and great ability to be productive members of our society. And a lot of them will decide that they're not going back into the same profession, or they don't want to be employed by someone else and they want to be employed by themselves and they want to take matters into their own hands. So, you know, the world will be very different coming out of COVID, and I think for the better. It's once again sort of like that Darwinian theory of survival of the fittest. And I want to encourage you and arm you and support you as best as I possibly can so that we make it through to the other side where those opportunities are really great. And that's when we want to be aggressive. Not now. Now is not the time to be aggressive. Now is the time to try and do everything in your power to stay healthy, sane, rational, be with friends, family, loved ones, lean on people, support other people. And one thing that I think is really important is to check in on your mental state. And I have good days and I have bad days. And I'm really grateful and thankful for Erica, who helps me through those days. And I'm here for her. She has bad days too. She wrote on, I think it was Facebook or Instagram the other day, that she was having nightmares. She's not alone. That doesn't make her weak. Like, this is a nightmare type scenario. And it's important that we check our head, that we stay level-minded, that we invest in the right opportunities, and we start to think. I just filmed a video. You'll have to watch for it in the next week or two. I was titling it, and I don't know what Charles will title it, but I was titling it "The Gift of Quarantine." And I think there's some really deep messages in there. I don't think it's going to be a very popular video. I don't think it's going to get, thousands and thousands of views like some of these about the economy do, because most people aren't really interested in doing the work or investing the time or, actually thinking about this stuff. But this quarantine is actually a gift. And if you can just think of it that way, then a funny thing happens. It becomes a gift. So connect with yourself, connect with your loved ones, start to dream about what the future looks like. And just because you were on a certain path before COVID doesn't mean you have to resume that path. The example I gave in the video, and I think everyone will understand it in this context, was, let's say that you were in nursing school, or that you were a nurse, or that you were in, medical school and you wanted to be a doctor. Some people that are on that path will want to do this even more. Like, they see the pain and the suffering in COVID and they'll be like, oh my gosh, I knew I was on the right thing. And now I want to double down and I want to do it even more. But there are other people who might say, you know what, like, this isn't really what I want to do. I see what their lives are like and loss, and then people are doing this. And, I was doing it because it was secure, or I'm interested in medicine. I'm interested in science. Like, they're doing it for other reasons. And it's okay. It's okay to change our mind. It's okay to say, the world before looked this way and the world after looks this way. And this is how I want to participate. And I'm not here to judge or encourage or anything like that, but I am here to ask the right questions and encourage you to ask the right questions and to support you in those endeavors. And for many people, that W-2 job that they thought was safe and secure and had pension associated with it, or had matching 401k, those businesses are not matching 401k. Those pension funds aren't really there. Many of those secure W-2 jobs are no longer secure. Many of those companies won't even reopen. So, like, it's time to really be asking those challenging questions and to take ownership and control of your own life. Don't wait for somebody else to do it for you, because they've got their own problems. All right, last question.
So I just want to.
Okay, we get the beauty. Our home's going down in the next 12 to 18 months. Laura, yes, my belief is yes. And watch a video. I just filmed it.
So I think you guys know that I'm a big fan of quotes. And so I came across.
By the way, we just got a thumbs down on the YouTube. And whoever that is, I want to thank you for expressing your outlook on life. It's an open world. I disagree with you, but I wish you the best.
In the midst of winter, I finally learned that there was in me an invincible summer. And I just thought that was so perfect for this time. So that while, we are in the midst of winter, you can really determine, you can be the summer in the midst of it.
Absolutely.
And come across, or come out the other side. And, what I will say is I have been amazed at how much time and money and energy I spent on, focusing on keeping up with the Joneses and, like
materialism.
Absolutely.
Things.
Right.
Yeah.
And to the degree of like getting my nails done. When am I going to get my hair done? When am I going to, buying this, making those reservations, doing that. And what I will say is, I have loved discovering what a phenomenal cook you are. I have loved discovering, so many things just about you and me and us together, and, reinvesting in so many relationships that I took for granted, and, reinvesting in myself and growing myself and trying to grow us, that I just hope that all of you find in you your invincible summer.
Yeah, no, thank you. And I think that's sort of the point, right? Like, this is, if you think of it as a gift and you're looking for things and you're trying to take control and ownership, we've been given a timeout. I think the language that I used in the video is, as a kid, you want a do-over. If you golf, you want a mulligan. we're now given this like forced timeout. The whole world is sort of basically coming together at the same time through the same experience, and we're on pause. And that's a gift for us to reevaluate, reconsider, align, change, focus. There's a lot of changes that are going to be coming out of this. A lot of people are going to look at life differently and how they spend and what they want to do and what they want to do with their time and who they want to do it with. And there's a lot of unintended consequences and unforeseen consequences. But, I encourage you all to take the matter into your own hands and be thoughtful about it, as opposed to just reactive or assume everything's going to get the same way and be the same way. It's not going to be the same way. And I'm going to ask that you guys all, there's a couple of hundred people on YouTube right now. Would you do me a favor and just click the thumbs up or the like button or whatever it is on YouTube? And I know that there's some issues that you can't really do it if it's on, I think it's your phone or on the desktop, but whoever can, just at least try, because I think the more people that see that a lot of people watch this and liked it and benefited from it, the more people will watch it and benefit from it themselves. And that's really why I do this, is to try and help all of you stay safe and sound and grow. So if you could do me a favor, I'd really appreciate it. Just go ahead and there we go. I got one person. Thank you. Whoever that, 3 people. Thank you. I appreciate it. And I just want to, before we end this, I just want to wish you all health and happiness. And it's not a joyous time. It's not intended to be a joyous time. It's a time to reflect. It's a time to be pensive. It's a time to not take a ton of action, right? So like, I started this conversation earlier today by saying I've been absent from YouTube for a couple of weeks, and it's not because I don't care. It's quite the opposite. It's because I do care. It's because I want to be thoughtful, and I want to have some research done, and I want to have some thoughts and some opinions, and I want to try and share with you. And I'm also going through my own 1031 and financing and construction and opening the Outer Banks, and I'm doing a lot of different things that helps me aggregate in total sort of my view and my outlook. Wow, we just smashed it. We got like 20 people. Thank you. And so, sometimes a pause isn't a negative thing. I think a lot of people jump to the conclusion that if they're not being active, they're not taking advantage of it. And I think the gift of quarantine is forcing us to slow down and to reprioritize and to think about what's important. And, that's a beautiful opportunity. And I don't mean to minimize the loss and the suffering and the loss of jobs and the economic destruction. That's all very real. But as Erica indicated, that's winter. And the beautiful thing about winter is always, whether it's recession or the weather, it leads to spring. And when spring happens, the ground thaws, the little seeds that you planted earlier, they start to come out. There's greenery, there's sunshine, there's warm weather. And in the terms of the financial markets and the opportunities in business and so on and so forth, spring is when you make all your money. You make all your money in spring. That's when you're aggressive. Then you ride it out during summer, and come fall and into winter is when you start to harvest. So we're in the middle of winter. Now's not the time to be aggressive. Now's the time to be pensive, thoughtful, plan, prepare, figure out what you're going to do. Draw down that home equity line of credit if it helps you sleep at night. If it doesn't help you sleep at night, don't do it. But think about all these things so that you're better prepared, in a more financially stable position. You're not as fearful. And if you catch yourself being fearful, find yourself a friend, a loved one, a colleague, a peer. Reach out to a competitor. It doesn't matter, but don't go through this alone. Go get yourself a cat, a dog, adopt one. We saw a wonderful story here. I think it was in Jackson, or maybe it was where your parents live. Somebody shared with us a story that like all the pets that were never able to be adopted before were fully adopted. They'd run out of pets. Find a pet, find a loved one, find a boyfriend, find a girlfriend, find an online boyfriend or girlfriend. Doesn't matter. Just don't go through this alone. And to that end, to the extent that Erica or I could be here, please email me, richard@str.university, Facebook me, go in the group, whatever. We're a community. We're one for all and all for one. And I really believe that. And I also think the best is yet to come. And that's what Airbnb and VRBO can do, is it can bring community together. We can be better hosts. We can have more excitement and more energy around our business now. Like, it should be more valuable to us today, not less. If you're in the wrong business, or you had the wrong location or the wrong approach to it, then it's less valuable. And that's telling you something. Time to exit. But if this is something that's meaningful to you and important and you enjoy it and you enjoy the home, it's connected to your why and so on and so forth, this is bringing us together. So, all right, I'm going to, spring is when you make all your money. There you go. Thank you. Very helpful. Thank you. Thank you. All right, guys. So we got to 92 thumbs up, but I'm not hanging up until we get to 100. And that's not intended to keep me here. It's intended for some of you that didn't hit the like button before. Now's really the time. I'd really appreciate it. Like I said, we filmed a couple of videos on YouTube. They'll be forthcoming over the course of the next few days or a week. We got 93. We need 7 more. There's not 7. You like it, Erica, or I'll like it. Hardik, you like it. Somebody. We got to get to 100. 94. Thank you. Thank you. In any event, people like you make America great. Thank you, Trey, my man. We are a team. Thank you, Richard and Erica. 3 family members, lots of friends, work for Disney. It's a sad time, a bit scary. When Disney opens, people will flock back to be sprinkled with pixie dust. It's the happiest place on earth. Of course, people are going to come back. And it is a sad time, and that's okay. I'm not trying to minimize it. We're at 98. I'm not trying to minimize it at all. I'm completely empathetic. I lost my job during a totally unrelated but not dissimilar crisis, and that happens. But we have 2 choices. We can either rise to the occasion or we can shrink, and I want all of you to rise to the occasion. That's really the goal. We're at 107. All right, success, friends. All right, listen, thank you so much. It's been an honor and a privilege to be with you for these last 2 hours, and I look forward to seeing you guys over in the Facebook group. Watch for those new YouTube videos. And I think on a go forward basis, we're going to continue to do these lives, and we're going to post videos on YouTube, but it's going to be less automated, meaning not necessarily Monday, Wednesday, Friday. It's going to be more as I have thoughts and things to add value, and I really want people to listen to them as opposed to just putting them out. I want to try and help as many people as possible. So, LOL, what's going on? Oh, 112, 113. Yeah, we're up there. All right, friends, have a great day. Have a great night. Have a great week, and stay sane. Reach out, spread positivity. It just makes the bad better. So do it. All right. Thank you. Thank you. Thank you. Have a great night. I don't know how to disconnect from this, so that's a problem. Okay. Bye, everyone.